Hi, this is ETF.com's Exchange Traded Fridays podcast, a weekly podcast covering developments in the ETF industry. My name is Sumit Roy, and I'm Senior Analyst for ETF.com. This week, we're talking with Dave Mazza, Chief Executive Officer at Roundhill Investments. Dave, welcome to the show.
Hey, thanks for having me today.
Absolutely. So, Dave, in a lot of ways, what we're seeing in the markets today is unprecedented. I know people have been talking a lot about stock market concentration for a while, but it seems like the breadth of the market just keeps getting narrower and narrower, with a handful of stocks accounting for the majority of the market's gains. Does that concern you?
No, I think you're absolutely right. I think starting last year, there was a recognition that a narrow number of securities were really the main driver of returns. But when we take a step back and look at some of the reasons for that, it concerns me less than the headlines would look. And it's less of a "this time is different," which we know are the most dangerous words in finance, but it's more the reality that we are in a winners take all economic and market environment where a small number of firms, which are really primarily big tech, Magnificent Seven, however you want to define them, are leading market gains higher, but they're doing so because that's where the revenue and profit growth has been. And that's why when we look at the actual fundamentals, there's not necessarily a disconnect between those companies that are out earning their peers versus those that the market is rewarding. If we were in an environment where the multiples of the Magnificent Seven stocks or a small number of stocks were increasing at a pace much faster than their revenue growth, that would be concerning, but that's not what we've seen to date.
So it sounds like, Dave, it's all about earnings, not necessarily some arbitrary percent of the S&P 500, because I noticed NVIDIA, everyone's talking about, it becoming the biggest, most valuable company in the world. It's something like 7% of the S&P 500 now. Even if it went up to 10% or 15% of the S&P 500, would that be an issue?
Just because the number is increasing or higher, I don't view that particularly as an issue. What I view would be, do we end up in an environment where essentially fundamentals are disconnected from price? What I think most are saying is that some are saying, yes, markets are overvalued today. And if money keeps moving into a small number of firms just by nature of individual stock purchases or index ETF purchases, then that will be an issue. But to me, it's not just about the number. It's really about the firms. And NVIDIA is maybe a unique example because really they have one primary business, which is selling semiconductors. They just happen to be far and away the leader. But if we look at companies like Alphabet or Amazon, while they're one ticker or one company, there's so many sub companies in them, right? Whether it's Alphabet with the search engine, with YouTube, with other investments they have, Amazon with the retail platform, Amazon Web Services, the list goes on. So to me, the number of names, again, aren't the issue. It's are people rewarding the right companies? And to date, again, when you look at the fundamentals, in those areas, they remain strong. That's not going to be the case forever, but for the time being, especially in a more restrictive rate environment where the largest companies are able to really outperform and navigate the uncertainty better, I actually think it's more logical than some may appreciate.
That makes a lot of sense. Dave, your biggest ETF is the Magnificent Seven ETF, ticker symbol MAGS. Super successful fund with just over $430 million in assets accumulated over just over a year on the market. Given everything we just discussed, I assume you think that the Mag 7 still have legs.
Yes. So our viewpoint is that the Magnificent Seven stocks, particularly a narrower number of them, especially the NVIDIAs of the world, remain in the driver's seat because of this winner take all thesis. But at the end of the day, I view the Roundhill Magnificent Seven ETF Mags as a tool for investors to express a view. And so if they agree with that view, then the Magnificent Seven can be a great precision tool for them to implement that. But I would also say we introduced Mag X, which is a 2x leverage version for traders. So someone looking to amplify that short-term exposure, but also Mag Q, which is a inverse of the Magnificent Seven. Now, interestingly enough, the Magnificent Seven Mags itself continues to gain the greatest interest of investors, and people are not necessarily looking to take an outright negative view. But at Roundhill, we wanted to offer people exposures to the entirety of the ecosystem, should they choose to express it differently, or should the market fundamentals change.
Dave, I know you're not an equity analyst, but what are your thoughts on Tesla? That seems to be the only member of the Mag 7 that hasn't been working recently.
Yeah, I think you spot out a great point. Tesla certainly has been an underperformer to some extent. Apple had been until recently with their AI announcement, and Tesla is suffering, I think, from the EV winter and, frankly, some overhang of really the management of the company. And again, as when two themes are really driving the market higher, generative AI and GLP-1 and weight loss drugs, Tesla does not have yet a clear play in those spaces. I don't expect them to get into drugs. That's not what I'm saying, but more on the AI side. And the stock has suffered. Their core business, which is selling EVs, has not seen the growth that it had in the past. So I completely acknowledge that particular company has faces some challenges, but the same could have been said about Meta a few years ago, and look at how they've been rewarded. So after many people left them for dead. So to me, again, the thesis behind this precision, the precision that Mags offers to exposure of the narrow number of stocks that are driving the market higher really remains, regardless of whether one company is completely shooting the lights out from a growth perspective like NVIDIA versus right now one like a Tesla not necessarily doing so.
Would you ever consider adding or subtracting stocks from the MAGS ETF, or would that completely mess up the branding and the strategy of the fund? I ask because before MAG 7, the acronym FANG was really popular, but people don't seem to use that as often anymore.
Yeah, no, you're absolutely right. So there, in the Magnificent Seven prospectus, there's flexibility to modify the companies that are in the portfolio, but it's not our intention to be changing those names willy-nilly or even without considerably care. So should the marketplace define the exposure differently, certainly we have the potential to adapt, but for the time being, that's not something that we're considering.
Fair enough. It's Sumit here from ETF.com. If you want to learn about all of the best ways to do portfolio management, make sure to also check out Advisor Upside, available wherever you get your podcasts. So let's talk about some of your other ETFs, Dave. One that was your largest for a while was the Metaverse ETF, ticker symbol METV, currently has over $400 million in AUM. Metaverse, of course, was a term that was very popular back in 2020 and 2021 when Facebook renamed to Meta. Was the Metaverse just a fad, or is this a real concept that people should consider investing in?
I think when we think about the Metaverse, you're absolutely right. The term actually has been around for decades, but it really wasn't until a well-known company decided to make a large pivot toward it where it gained real prominence. And this to me is a theme that still has a lot of durability, but the path toward its growth and acceptance is not linear. And that's one of the reasons why both the share price of many of the companies has underperformed. But if we think about where the puck is going and what the future begins to look like for the intersection of advanced reality, mixed reality, virtual reality, the metaverse still has a lot of legs, but the potential for it to come to fruition, may not be happening in the next year or two. It could be more of a decades in the future.
Another secular theme that seems to be really taking off lately is online gambling, Dave. You have an ETF tied to that theme called the Sports Betting and iGaming ETF, ticker symbol BETZ. Can you talk about the investment case for the ETF?
Yeah, so when we think about the bets ETF and online gaming and sports betting, this is another area where the catalyst for sports betting and to some extent online gaming really is a regulatory one, and we saw a lot of states begin to move toward legalization of that or broader acceptance in many ways. And now I think we are waiting for other states, perhaps to California, to come online to really provide that push higher. But this is also, to me, when I think about themes that have durability, they may not fit every investor's portfolio, particularly any thematic equity, but this is one where there remains to be strong potential catalysts for it, and investors who are interested in the space likely need some patience for that to play out, because where we have seen legalization and as the just broader digitization and again acceptance of the intersection of gaming and sports betting grows, I think the movement toward digital away from brick and mortar only keeps increasing.
And are the names in this ETF companies like DraftKings and things like that?
That is correct. So if we think about the names that the top five names in the portfolio, it's Flutter Entertainment, DraftKings, Churchill Downs. These are all names that folks would find in the portfolio.
Another one of your funds, Dave, that I'm really excited to talk about is one that launched recently, actually. It's called the GLP-1 and weight loss ETF with the ticker symbol OZEM. Do you think weight loss drugs can be as big as some of the analysts are projecting? I'm hearing that they could be the best-selling drugs of all time.
When I think about the GLP-1 space, these are groundbreaking treatments. We know that global obesity rates have tripled since 1975. They're projected to impact half of the population by 2035. Goldman Sachs research, which is, gets a lot of attention in this space, forecasts that the obesity treatment market could hit $130 billion, and to your point, could be some of the best-selling drugs ever, is because there's a real need, and there's unmet demand, and the space is so wide open that right now there really is only two companies, Lilly and Novo, that have drugs in market that have just incredible efficacy as treatments in weight management. And we're also seeing that there's other applications for them. So to me, we remain in the incredibly early innings here. Investors have latched on to a handful of names that have shown the ability to grow revenues in this space, but others are coming. And it will not just be a Lilly and Novo story. With that being said, we give them incredibly healthy weight in the portfolio because they have drugs in market. But as others move move into various trials and show efficacy, we think there will be other winners as well.
Can you talk a little bit more about, the portfolio today, Dave? Obviously, everyone, like you mentioned, thinks of Novo and Eli Lilly when it comes to these drugs. I think Lilly is approaching a $1 trillion market cap. Novo's around 600, $700 billion. How big are the weights of those two companies in the portfolio, and how many names are in the portfolio in total?
So OZEM provides exposure to weight loss drugs in a few ways. So one is companies that are diversified in the pharmaceutical space. So this would be a Lilly and Novo, but they have in market GLP-1 therapeutics. Then there are smaller biotech companies that are just creating the GLP-1s. Other companies that are enabling the ability for larger pharmaceutical companies to do that. The way we weight the portfolio, though, is very unique, where those two companies, because they have drugs in market, there's revenue being produced from them, and the earnings growth of those two companies came almost entirely from their weight loss drugs. They have the highest weight, so around 20% for each of them. And then down the line, companies that have a phase 3 drug, in market would get a higher weight versus a phase two versus a phase one. So there is, when we think about the tail of the portfolio, there's going to be companies that are more speculative, right? There are companies that are working on oral therapeutics, so meaning you don't need to use the injection pens to do so. Some people don't find that comfortable or would be unwilling to stick a pen in themselves to lose weight. And then there's other companies that are Amgen, for example, which is a more well-known company. Some of the results that they have produced in their trials show even greater efficacy than Lilly and Novo have. And so that's why Amgen is the third largest holding, but it's less than 5% because they don't yet have a drug in market.
That makes a lot of sense. So, Dave, you have so many interesting thematic ETFs. You have funds tied to cannabis, LNG, the luxury goods market, even the zero-day options market. But the last one I want to touch on today is your Bitcoin covered call strategy ETF, ticker symbol YBTC. What's the appeal of putting a covered call strategy on top of Bitcoin?
The real appeal is so we know Bitcoin has had over the long run incredible returns, but it's also come with incredible volatility. And the idea of introducing a covered call strategy on Bitcoin takes advantage of that volatility. So we provide exposure to Bitcoin through subject to a monthly cap because we are selling upside, but we can generate strong potential monthly income through this covered call strategy because Bitcoin has historically been one of the more volatile asset classes. So when we think about the most recent distribution rate, it's close to 43% annualized because Bitcoin is so volatile. And by selling your upside, generating significant premiums through the use of options, that can be beneficial for income-seeking investors. So we have there's two schools of investors that are using YBTC. Some are, I'd say, more Bitcoin forward or crypto zealots, maybe, where anything with exposure to Bitcoin they're interested in. And this is a means for an asset that doesn't allow staking, for example, or doesn't allow income like other crypto projects can. YBTC can do that for those folks. But then there are also investors who are very interested in gaining income through a variety of sources. That's one of the reasons why options income funds of all shapes and sizes have been of interest in recent times. And YBTC is a new flavor of that by doing so with Bitcoin. And because of its historical volatility, can be particularly attractive from a potential premium perspective.
Well, fantastic. Dave, we're going to have to leave it there. You gave us a ton of great insight. Thanks so much for your time.
Thank you for having me.
Like that episode? Make sure to subscribe to Exchange Traded Fridays so you won't miss the next one. Available wherever you get your podcasts.